You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, that music means it is time once again for the Advisor's Option, the program where we break down what the heck is going on with these options things so that you, the busy financial advisor, asset manager, you can help your clients understand them, and you too can have a growing understanding of them as well. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting The Options Insider Radio Network. You can tell I'm pumped to talk about some advisors and options listeners, and joining me to help me do just that, my 2 cohorts, my partners in crime. Let's start off. Let's go out to the quiet, the tranquil hinterlands, not quite of Maine. We're not quite going that far. That's every Monday and Thursday. No, instead today we're dialing it 1 over to New Hampshire, where we are joined once again by Mr. Matt Amberson, the principal over there at ORATS, a.k.a. Option Research and Technology Services. Mr. Amberson, welcome back to the program, sir.
Excited to be here. Beautiful up here. Leaves are turning. Not too many leaves like these down in Puerto Rico.
No, they are not, as we continue turning the dial clockwise out there into the Atlantic to a small little, somewhat tropical island known as Puerto Rico, where we are joined once again by the Director of Risk himself, Mr. Chris Hausman from SWAN Global Investments. Mr. Director of Risk, welcome back to the program to you as well, sir.
Guys, always a pleasure to be on, and you're right, the palm trees are the same all year round. It's really a travesty.
All right, let's keep the ball rolling. It's time for a little bit of the old buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to the buzz, where we break down what the heck has been going on in the world of options and derivatives as it pertains to you, the busy asset manager and RIA financial advisor out there. A lot's been popping off since our last episode. Let's get to it. But let's start, as we are wont to do, kind of looking at how things are shaping up right now from an overall broad market and volatility perspective. We are in this kind of interesting zone. I think you can say that for the better part of this past year. Every month, something interesting has been happening, of course, around the tail end of people thinking we had maybe a deal with Brexit, then perhaps not so much. Trade war, will they, won't they dance, that continues to go. Of course, Middle East, if it's a day that ends in Y. There is some sort of kerfuffle in the Middle East, all that combining for an interesting market environment where we are right now, where, of course, the markets have been effectively top-heavy for some time. A lot of people at least viewing it that way. And volatility also eroding a bit, but not quite getting down to that, threatening that single-digit level, anything like that. Still fairly frothy, VIX and spikes both hovering around that 14 and change level. So obviously still perhaps a few other shoes left to drop out there. Let's go the way we came. Let's start with Matt. Mr. Matt, sir, it's been an interesting time. We're up, we're down. Markets are up, markets are down. Volatility is up and then down a bit, but then still retaining a little bit of vim and vigor out there. So what's your take on what we've been seeing over the past month since the last time we've been chatting, sir?
Yeah, we look at contango to start out with. At least I like to do that. Look at the front months versus the back months. A lot of people look at VIX, and it's pretty similar to the SPY or SPX. And it's been, last couple weeks here at least, our measurement. So there's been more contango, which means less problems for the market. So as all this tension and trade wars have gone on, the market has quietly shown signs of the alerts, turning from red to green, and it's been kind of positive lately. Earnings, we'll talk about that later, but that's been really to foreshadow what I'm going to talk about. It's been a non-event, not a non-event, but it's the owners of options have not done real well. So it's quieting down in the land of ORATS, Mark.
It's never quiet in the land of ORATS, sir. There's always some data to mine and something to parse out there, sir. So there's no rest for the wicked. Of course, we're talking wicked. We're talking about the Director of Risk there. Mr. Hausman, what's been on your radar over the past month? Have you been rolling the front portion of the DRS and trying to mitigate what's going on in the back portion? What's been on your radar in the current tumultuous market environment, sir?
Okay, well, it was interesting with what Matt said is there has been a lot of variability in the shorter-term part of the curve, and I'm referring to the VIX term structure. But what's interesting to note is if you look at the longer term, it's been very, very stable. It was low around March, April this year, and has actually started to pick up and has been very stable. And the same thing is emanating in the S&P 500. And I think people are, you've got short-term events, so all the tweets and the trade wars, really the market's digesting that as short-term events. You've got all this variability on the shorter end, but I think people are now starting to get a little bit more concerned about the elections that are, a year away from now. And so if you look at longer-term vol, it's actually held very, very well considering, how much the markets are up this year. So that's kind of a different take on what we've been seeing lately, where, it's really acting like you've got two different vol structures. So the short term is still, it has its events and it's swinging violently when we get these type of events. I mean, lately it has come down quite a bit, like Matt mentioned, but I think there's a story to be told in the long term, how well it's been holding up thus far this, in the last few weeks, few months.
Speaking of short term versus longer term, we were discussing this on a recent episode of Volatility Views. I thought I would put it to you guys as well, because it's kind of interesting. The Journal was putting out there an interesting chart of what effectively was the ratio of VIX itself, which is, of course, a measure of 30-day implied with a bunch of other things mixed in out there in the S&P, versus what is VXXT, which is a shorter-term 9-day type of measure. And they had this interesting graph of kind of the relationship between the two. And at first I thought, I don't know how useful that is, because anyone who's out there who's savvy, who's doing this for a living, is certainly going to be paying attention to what Matt was referring to earlier, the contango or lack thereof of the VIX futures, and a lot of that information is going to be readily apparent there. But maybe someone else pointed out, maybe, for someone who's not quite as deep in the weeds as we are, something like this, a graph like this, which is effectively showing you what the heck's going on the front portion of the curve, is maybe a more informative and useful tool. I'm curious, Mr. Director of Risk, is this something that comes across your radar? Do you even use VXST in your analysis, or do you kind of go straight to the VIX futures curve for all of your hot and heavy vol information, sir?
Yeah, we don't play in this type of short-term space here. Being just a 9-day volatility. I mean, it's definitely useful to monitor. But again, you've got to pair up, what is your days to expiration, your tenor, your maturity to, proper tools. And so we probably tend to focus more on the VIX, tend to focus more on 60-day and 90-day type volatilities. That's kind of the sweet spot for the premium selling that we're doing. But a lot of other premium selling programs are doing weekly options, and I can see how the VXST would be a very important metric for them.
Mr. Matt, you're always looking for metrics and analytics. You like a little bit of contango. You said it earlier. Is this particular ratio, this VXST to the core 30-day VIX, is this something you ever look at in your analysis?
Well, we have a 10-day and a 30-day, so that's how we do it. And I'm seeing the same thing, and I think it's a real good indicator. And the short term is real. We have a client. They said, "Hey, do you have 5-day?" I'm like, "Come on, So now we're going to start calculating a 5-day implied volatility."
Everyone wants their own slice of the pie, sir. 9 days isn't good for you. You want 10. Your listener or your user wants 5. And everyone's got their own metrics, sir.
Yeah, I mean, I thought a 10-day. We cover, all the optionable stocks out there, and a lot of them don't have any. There is no difference between often a 10-day and a 20-day, even a 30-day. But now with all the weeklies and all the expirations, people are really moving down into the weekly. And I talked to a guy the other day that traded like 1 day. He would just open the market and he would either buy a call or a put, and it would be a 1-day option. So that's really getting down to the shortest of all possible terms, Mark.
Yeah, when we discussed binaries on the last show, those get into the 5 minutes. But you're right, for like the listed actual options, it's all heading there. It's all heading to daily. I always tease the various exchanges whenever they come on and they're talking about the new edition of the latest weekly product. They guys keep saying, when are we going to get to the dailies? Because that's where all this is headed, and they always push back. But we know eventually we're getting there. Speaking of getting there, let's get to the earnings. You kind of touched on it earlier. Actually, you know what? Before we do that, Mr. Matt, I had a guest in here last week for one of our programs, and they may have mentioned to me that they did an appearance with you not so long ago out there in the alts mecca of Dallas, where you guys were holding court bright and early on a panel about all things alts down there in Texas, sir. So what was going on down there in Dallas? What were you talking about? What were you regaling the fine folks of Texas with about alts, sir?
Yeah, it was a great conference. Eric Metz, been a longtime friend and colleague, one of our first clients at ORATS, so it was great to get on a panel with him. The OIC asked us to do it.
That's strange, because he had horrible things to say about you.
Yeah. We had a good time down there, and Eric really concentrates on some things that I don't, so it was really fun to talk. We talked about some concentrated positions, and he was able to get into some of the specifics of the rules, so I learned a bit there. No one will write down anything as far as what effectuates a sell. But he got into that. It was really interesting, and we talked about a lot of the things that we talk about on here. How the VIX is looking, how and then we talked about some covered call strategies. But it was a good time. Saw some SWAN folks down there. It's always fun to see those folks. It's well attended and fun to see Eric and of course your name came up, Mark, but all in good fun.
All bad, I hope, because otherwise I'm not doing my job here properly. But let's get to it. Let's get to all things earnings, because you guys are indeed the keeper to the keys of the earnings kingdom, and we're back at it, Matt. The last time we talked, it was kind of the dregs of what was happening on the tail end of last season, but now we're back in it. We're back in the teeth of earnings season. We had all the big financials popping off last week, as well as Netflix and IBM. This week, there's more big names on the docket. So chances are, if there's a big name you like trading or following out there, it's popping off sometime in the near future. And chances are, Matt and his team have crunched the numbers for us. Mr. Matt, sir, I know it's still early going, but we got a week and change under our belt here for this new season. What is lighting up your radar? How are things progressing so far, sir? I know last season was a historically crazy one. Are we even close to matching that yet?
No, it's the opposite. 13% of our firms, in my analysis report that I'm looking at here, about 100 companies that reported that we watch, and it's been a bloodbath for the owners of straddles. Normally, you'll see maybe 95% return actual moves versus implied moves, and it's down to 77. 68 was the front. Was the first week, and that's actually normally what we do see is the first weeks don't pay off as much for option owners, but that was a really bad week, and this week is just continuing that. 84% returns, average is 87. I predict next week I'll get a little bit busier. That's what at least it has done historically, but gosh, last season was as wild as we've seen ever. So that was we had so much going on in the market, and so that was quite a crazy season. But this season's starting off just the opposite, Mark.
Sometimes we see that. Obviously the past is prologue, and if we have a wild and crazy season, you're going to see people pricing that in for the next season, right? You're going to maybe widen things out a little bit, and maybe you think that's what we saw here, Matt. People just got a little bit burned last time, so they widened things out. And lo and behold, we don't make those numbers now. Is that what you think is lighting it up out there?
Yeah, I mean so we look at what's the implied percentage move, and we average those over all the firms yet to report, and that's gone from a historical average of 4.2 up to 4.9. 4.8 is the past earnings move, and that's up to 5.3. So we were seeing still an implied to past earnings ratio of 94%. So that kind of makes a bit of sense, given that it's the implied earnings move and the past earnings move, just largely because of last earnings, is definitely inflated. And but definitely not coming in. I mean, we only had actual earnings moves of 2.7, which is one of the lowest percentages. Like I said, it's usually around 5.5. We've done a study of thousands of stocks going back to 2007, and it actually is a slight. It's usually about 40% winners, 60% losers from owning straddles, but there's a slight benefit to owning straddles just on the overall. They're both losing strategies because of slippage and commissions, but owning options, it's a little counterintuitive, but if you think about it, 40% winners, but you only have to win, a few times because you're owning and you're making it, you're making a pretty good amount. So that's what we're seeing. That's what we're seeing in this one. Yeah, inflated prices and the actual moves not up to those, Mark.
Mr. Director of Risk, is this something that comes across your radar? I know you're mostly focused on the macro and the rolling of all the SPX positions, but obviously earnings season has an impact on overall volatility. Is this something that comes across your radar? Have you been using the ORATS reports maybe secretly behind the scenes, sir?
We do look at it. I mean, we definitely have some overlay accounts that are single stocks, so it's something that we have to take into consideration. But I had a question for Matt. Have you done any work on like a particular stock, whether it has a bullish or bearish tilt after an earnings announcement, and if that is affecting the skew? I mean, you've done a lot of great work with, the at-the-money straddle and how raw volatility is acting, but is there actually a delta tilt to certain stocks after they announce earnings? And, is the options market already kind of front-running that, or how accurate is the skew call versus a delta move in an underlying after an earnings announcement?
Yeah, so when I was on the floor, I used to get picked off all the time, and they would come in and they'd know. They'd buy the puts, they'd buy the calls, and so we went and baked all that, and I looked for everything. I couldn't get an edge looking for that. You'd think you could, but it's so kind of rare, I guess, for them to know, and it seems like they're better at hiding it now. Back in graduate school, we did these studies on the drift before. So what we found was if there was a little positive drift, then earnings was usually positive. But I think that's much more muted these days, and like that's been a tougher and tougher nut to crack is what's bullish and what's bearish in these. But I've tried and I haven't found anything yet, Mark.
All right, well, let's keep on rolling with the buzz here. We got to get to the atom bomb that went off in the financial world since the last time we gathered here together on the show. In fact, this went off exactly when I was down at the STA conference a few weeks ago. So what better place to be when this type of news breaks than at an equities market structure conference? Of course, I'm talking about this just race to zero on the brokerage side of the fence these days. Charles Schwab, of course, on their earnings call, kicked it off when they said they were making the jump that a lot of firms have been exploring behind the scenes ever since. Obviously, zero commissions has been around for a while. Robinhood making it famous yet again, but other firms even back in the day like Zecco and even before then have tried this with usually mixed results. But now the entire space embracing it. Shortly thereafter, TD Ameritrade said they were going that way as well. Our friends over there on the option block, Fidelity, I was teasing them for a while. I said, when are you going to go? They pulled the trigger. There's zero commissions down as well. Ally, our friends over there on Options Playbook Radio, also pulling the trigger. Zero commission. E-Trade following suit as well. Now Merrill Edge jumping into the fray recently as well. So pretty much pick your broker. They're going that way. We've actually seen some announcements as a result of this. TD just had their first earnings call in the wake of this race to zero commissions. They claim new accounts jumping 49% since they dropped their commissions. So they're seeing it as a boon for the space overall, even though most of these firms took a little bit of a hit on their stock in the near term. A lot of analysts downgrading or moving their status to hold in the wake of this unknown future here for the commission side of the space. Of course, we focus here on advisors. A lot of people have been looking at that side of the space as well and how that's really going to be potentially impacted by this. Charles Schwab himself coming out, doing an interview, I believe last week, coming out and saying he thinks this is going to be a great thing for not just the end self-directed clients, but also for the financial advisors. He thinks it'll give them more tools to go back and combat these other advisors who kind of masquerade as both advisor and broker and charge you commissions. He says this gives them, those RIAs who kind of want to just do it on an annual basis, the way he thinks it should be done, this gives them more tools in their arsenal to be competitive from a fee perspective against that. He says advisors can now charge what they should be charging, a small amount per annum for their services. And this has become so compelling now in the advisor space. Raymond James now jumping on board as well, giving free trades to the advisors. Now, this is a different shift. This is one of the first ones of these we've seen where it's not aimed at the retail. It's aimed at the RIA. It's aimed at the professional advisor, where there aren't going to be self-directed trades by individual clients. That's a move to allow those guys who are making trades on behalf of their clients to be competitive with the firms like Schwab and Fidelity and TD. This has been just the thing everyone has been talking about since it happened, and with a particular laser focus here in the advisor space. A lot of different surveys, wealthmanagement.com going out, talking to a lot of different advisors in the wake of this, and people, as you might imagine, are maybe a little bit excited because it's driven a lot more interest, as Schwab has shown and TD have shown, driven a lot more interest from the end user in the space. I mean, Matt, you were just talking about your strategies before and how once you factor in slippage and indeed the commissions, that becomes a much more difficult prospect to make a lot of these strategies work. So some people are excited by that. Of course, the other side of this is how is the execution going to be? Because obviously when you're paying for things, you can expect a certain level of execution. When things are free, maybe is the execution going to suffer at the end of the day? And everyone obviously who knows the option space knows you really live and die not on the commissions but on the execution. And that suffers as a result, then maybe this could be a negative for all this. So I kind of want to go around the horn, and you guys have had a couple of weeks now to digest this news. It's still popping off as we've seen Raymond James just announcing a day or two ago that they were joining the fray as well. So it's still very much evolving, particularly on the options and RIA side. But I'm curious for you guys, in general, what are your thoughts on this and how it could potentially impact the advisor space in particular? Is this a good thing? Is this a bad thing? What have you been hearing from folks? Maybe Director of Risk, we'll start with you, sir.
Well, anything for free is theoretically good, right? But I think what I haven't heard enough about or studies coming out is, what's the impact on execution? I think that's going to be, especially when you're talking about stocks. I don't think all these groups are wanting to do this for free. I think we know that we live in a world of high-frequency traders, and they are running the show kind of behind the scenes. And a lot of these places do sell their order flow to a lot of organizations. So, maybe the payment isn't upfront from a client, from a customer through a brokerage fee, what have you, or a ticket charge. But now, all these shops are starting to get more their compensation or their revenue from high-frequency trading organizations. And I think it's an HFT dream to get more volume out there. And I think, the test is going to be on what kind of execution clients are going to get. Is that free ticket going to be worth the slightly worse fill that you get? And that's what we've kind of alluded to. It's an experiment in my mind until people start complaining more and more about executions, if that happens.
Yeah, that's obviously the big lingering question, right? And we haven't had enough time to really measure the impact. I know Best X is a thing the industry is focused on, and they don't want to backpedal from that. But when you see everyone moving away from the commission side of the fence, that does make you wonder exactly what would the fills be like. And if you're getting bad fills, then all this other stuff is kind of moot. Matt, same question for you. You're out there interacting with a lot of clients on all sides, on the professional side, on the high bleeding end of the retail side as well. What are you hearing from folks? Are they excited about this? And also, what are your thoughts? Is this a bane for the space? Is this a boon? Or what do you think about all this craziness going on here?
I was watching Steve Eisman of The Big Short, and he didn't comment on this directly, but he commented on the free checking that came. I don't know if you guys are old enough to remember when you used to pay for checking, and when a small bank in Minneapolis started free checking, everyone pounced on that. And what Eisman said is that they actually are making a lot more money on free checking because they're, quote unquote, ripping your face off with many other fees and other things that happen and balances and all that. So there's no such thing as a free lunch. I think they're going to get, the money that they need somehow. Execution I didn't really think about too much because that doesn't really benefit the trading firms all that much. But payment for order flow and all that is what I think about. I mean, if they make it up on more balances and more people trading and such, that would be great. I mean, if we could get more people into trading, and because of the commissions, I mean, you're going to see a bump up. I was on the phone with my broker, talking to him about that at TD Ameritrade, and some of them are only offering web only, but the TD Ameritrade offers Thinkorswim as well. There is a small charge for options still because I think they have to pay some exchange fees or something. But so there are some fees, but it's really come down. It's been great for me as a trader. So, I'll trade more. So, I mean, I think that's good for the industry and hopefully, tangentially good for the brokers, Mark.
Yeah, you're right. I should clarify that. On the options side, nothing is entirely free, and there still are some not ticket charges anymore, those are gone, but per contract charges of 65 cents. Looks like a lot of the brokers have settled around that level. So the ticket charge is gone, but the per contract charge is still there. So options not completely free. Options, obviously, a little bit of a different beast than your Delta One stocks and ETFs and other things out there. And you're right, too. It might be interesting to see, of course, there's always payment for order flow behind the scenes lurking, and to see how that makes up for some of this. I'm sure they'll be leaning on that even more. And also maybe we will start to see some of these surprise little pop-up fees, like maybe an account maintenance fee or, web access fee or whatever the case. But all these things like you see on your cell phone bill, these ridiculous fees that pop up out of nowhere and have no relevance to real life, but they're a way to gouge a little bit extra out of you. Maybe we'll start seeing brokers move to that. So the upfront fee may be gone, but the fees may be hidden out there. So really quickly, we had an interesting question come into one of our other programs here. I thought it'd be worth commenting here as well. I want to get your guys' thoughts on it. It came in from one of our listeners. Let me get the name here. I love our listeners always think of interesting things. This did not immediately leap to my mind when I first saw this. It came from Erik Norstedt. He wants to know, hey, Mark, great show. Well, thank you. He goes on to say, with some of the major brokers offering no trading fees, do you think this will lead to an increase in volatility since traders can now trade more? Matt, you just said you're trading more. Are you jacking up the vol for the rest of us, sir?
Yeah, I think it's the opposite. When you have more people trading, I think you see more liquidity, tighter markets, things get out of whack less often. So I think it actually will decrease the volatility, if anything.
Chris, do you concur, sir? You think vol's going up or vol's going down, or vol kind of unched in the wake of this race to zero commissions?
I think that's going to be interesting. I don't know. I would have to take the other side of that and say it could increase volatility. Going to depend. In theory, hopefully it is two-way order flow and it does contain. But if everyone is trading the exact same thing, then I'm going to have to lean towards more volatility down the road.
Interesting. A little bit of a divergence of opinion. If I cast my vote, I probably have to lean the way Matt was, because you'd think in general more retail flow coming in, pretty much hitting bids, lifting offers, and that sort of thing. More of that, 10 lots here, 20 lots there. More of that just effectively should add into more liquidity. So you think it would have a little bit of a little damping down effect on volatility. But maybe if we see some weird aberrant developments as a result, then perhaps Erik could be onto something. Obviously, still very early days here for this, but a fascinating thing. Obviously, this is just the first iteration of this story. This is going to fundamentally change how a lot of the business is done in the space, both on the brokerage side and, of course, on the advisor asset management side. So we will stay tuned to this one. But you know what? Since we're talking zero commissions, let's get into it and how that might impact your options trading with a little bit of the old Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, let's get to Options 101, where we break down some of the educational options, topics, and strategies and things that you could utilize in your own clients' portfolios when it comes to options. And this segment also inspired by a listener question. So our listeners are just leading the dance today. This one comes from Robert. Robert wants to know, now that commissions are gone, are there any trades that are back on the table that would have previously been just too expensive? So I thought that was a good segue into perhaps talking about some of the strategies we don't talk about here for a lot of reasons. We touched on them in the past, obviously, but not a regular go-to. For one of those reasons being that they are multi-leg strategies. They involve a little bit more sophistication, a little bit more knowledge of the underlying and the options products, and also, of course, they are expensive. So the race to zero commissions has removed, or I should say really mitigated, not quite removed, because there still is that 65-cent contract charge. So if you're doing a lot of contracts, it's still going to cost you some money, but it's going to cost you less than it would have before. I think that's a good thing. So let's get to some of these multi-leg. Let's talk usually 3 legs, maybe more. One of these has 4 as well. It's usually the multi-legs, listeners, where things start to get funky and really expensive. And I should also put the caveat out there that we're not recommending any of these. It's not like we're saying, hey, flies are great now because things are cheap. If you want to use a fly, if that should be the strategy you should always use, regardless of what's going on from a commission perspective or things like that. But in general, these are a little bit easier to use now that the cost has gone down. So let's start with some of the basic, one of the most basic and popular three-legged type strategies out there is the old butterfly. And why is this expensive? For a couple of reasons. I just mentioned it's got 3 legs, so that's always, those leg components are going to tack on charges. So it involves multiple contracts. You have a ratio in this one. So that's going to tack on some more fees for you there as well. But let's go for a nice basic call butterfly. Let's break it down. And our old friend, everyone's favorite name, we've all made and lost fortunes in this name. Of course, XYZ. Let's say XYZ is trading right around $50. And you're feeling a little bit of modest upside, maybe decent upside in this case, but you don't want to shell out and go out and spend a fortune just straight up buying an at-the-money call, let's say. Let's say in our example, that 50 call cost $1. And you say, I don't know. I don't know if I want to shell out $1 for that. I think it's going to rally maybe to 55, maybe a little bit beyond, but not that much farther in the near term. Well, then you can do something like a butterfly. And in this example, the call butterfly, you're going to buy that 150 call for $1, so you're still doing that. Then you're turning around, going to that 55 strike, you're going to sell 2. That's where the ratio comes in. Of that 55 call, let's say in our example, that 55 call worth 50 cents. So you just paid for your 50 call right there, bam. But now, of course, you have a short leg. You have a short risk. And we talked about before on the show not being short units unless you have some reasons or some understanding therein. So let's go and add another leg beyond it. This is the third leg. This is the kicker. That's what usually costs people money from a commission perspective to protect against that extra short leg. You don't want to have naked short risk north of the 55 strike. So we're going to buy a 60 call as well. We're going to cap our risk to the upside at that 60 strike, and we're going to pay, in this example, 25 cents for that. So we paid $1 for a 50 call. We sold 2 55 calls for 50 cents. So that equates to $1. So $1 versus $1, we're flat there from an outlay perspective. And now we're going to turn around and buy one more of the 60 calls, just in case the worst comes to pass and this thing explodes. We want to max or cap our risk out on the upside. So we paid a net outlay there of 25 cents. You can see the value right there from an outlay perspective, rather than paying $1 and watching that erode against you. Your net outlay now is 25 cents. Your profit potential is that spread, that 50-55 spread. That's what you're looking to get. You want, ideally in this scenario, the stock would rally to 55 and sit there, and you'd be looking pretty good. But you're covered a little bit all the way up through there. And then if the worst comes to pass, if it blows past 60, you don't have to worry about much risk beyond that strike. So that's a nice thing about this trade. So your outlay is mitigated. Your risk is mitigated. Your profit also, I should point out, is mitigated as well. You're not going to get, if it explodes to 65, you're not going to keep all of that. But the benefits are many as a result. So maybe we'll start with you, Mr. Chris. Are you a fan of flies? I should also point out, you can do this with puts as well. It's the same analysis to the downside. We just happen to use a call fly for this scenario. Are you a fan of flies? And also, do you think, the race to zero commissions, we're going to start seeing more of these types of strategies popping up on our radar, sir?
Well, I'll take the second one first. I think, for me, if you have a good strategy, I've always been a believer if the strategy comes first. So if you have to hit the bid and lift the offer every single time, the strategy should be able to overcome that. So if the strategy can overcome that, it should obviously be able to overcome commissions. So, however, a lot of people don't think like that, and commissions may or may not make them do certain strategies. So I would think that, yes, with zero commissions out there, you're going to see more of these multi-leg strategies start to trade out there. Personally, I love butterflies. I was very fortunate to learn from a guy that was a butterfly expert and sat right next to him for many, many years. I think one of the problems with butterflies today, or in the last 10 years, though, if you look at the at-the-money butterfly or at-the-money condor, and I'm talking about like in the S&P 500, and you can just see that from the B-fly index or the CNDR, the condor index, it's been very, very challenged over the last 10 years. And so the way I like to trade them is more tactical flies, like putting flies up top or flies below, kind of like in the example that you had here. I think there's a lot more success doing that. You have to do a little bit more homework with skew. And then taking it a step further is to leg into butterflies we all learn call spreads and put spreads, right? Basic buying call spread, selling call spread. That's all a butterfly or a condor really is. So I think the next step, once someone gets really familiar with, first of all, when they realize they're not making any money or losing money with the at-the-money butterfly, then they can move to tactical flies, right, with some type of delta lean. And then after that, they can try to leg into the butterflies, which the last few months have been a great environment for butterflies. We've been able to leg into a lot of butterflies for credits. So that's my favorite position, where I can just sit back and not have to worry about it. And, kind of reminded me of the old days when you were able to do that all the time. So
you're right. It does seem like a lot of the old school market maker guys, the flies is just their position of choice. That's their go-to all the time. You're right. They usually tend to play with it too. Like in our scenario, I kind of went straight at the money fly. But it sounds like for your tactical purposes, you would be thinking more about moving it up a little bit, maybe to the 55 or maybe even the 60 strike and take advantage of some skew. And do you also play around? A lot of people like to play around with that strike interval, maybe doing some skip strike flies. Is that an approach you like?
Yeah, the broken wing fly or broken wing condor, when you skip a strike, that's just another way to add a little bit more delta, add a little bit more skew if you want. So again, you need a little bit more homework. I guess the fly in the condor has grown up. That basic garden variety at the money fly condor just isn't quite working, at least in the S&P. And I'm talking about the S&P 500. It may be working in other products, but again, it's been very challenging. I think you have to evolve and pick your points, pick your spots. Assess where skew is, because it's not really a volatility intensive structure, but it can have some skew. And then you can have more success, trading the flies. And, there's always a saying in options trading, right? Where you are, you want to be away from your longs and toward your shorts. Great. That's when you should be booking profits. And the next line after that is where you are today, you won't be there tomorrow. So if you don't book, I've had many a fly looking at the potential profit going into expiration week and licking my chops, and then it goes out worthless. So, those are years of painful, maybe young trader greediness type stuff. But I think it's very important to manage butterflies and then take your profits. And yeah, you can. It's so versatile because you can turn it into a call spread, long call spread, short call spread. Then you can leg out of that and just have your outrights if you want. So I think it's one of my favorite strategies.
It is very versatile, but you're right. It's not really a set it and forget it. Some people like to do it that way. They say it's all mitigated, put it on. What do I have at expiration? Okay, but it's going to perform a lot better if you get in there in between and make those tweaks and adjustments that you need to do. Matt, are you a fan of flies? B, are you going to be trading more of them now that we see lower commissions? Sounds like the answer to that is yes. And then C, are you like Chris? Do you like to take maybe a more tactical approach, maybe moving away from the money, maybe doing the broken wing stuff? What is your take on the fly these days, sir?
Yeah, one of my favorite strategies is it's basically a put 1x2 with a longer term out of the money put. So it's like a broken wing butterfly, but that lower strike put is a lot longer term, and you do it for a credit. So you're essentially getting some protection for free if it works, in your favor. And then you could do actually some ratios on the small side. So I know that sounds a little complicated, but yeah, I like to do, take advantage of the skew that usually exists. So you're selling, you buy one, somewhat a little bit out of the money, and then you sell two, more out of the money, and then you buy one or two longer term, and you could do that for a credit and keep rolling that. So that's one of my favorite things to do, and then but I should also say this: the bee fly that Chris alluded to, the SIBO's butterfly index has just gotten stomped on since August to the beginning of August to the beginning of October is down 10%. And it's since come back a bit, actually pretty good rally the last week, but the people should look up BFLY, and you could go to the SIBO site and download the historical performance. I think it's interesting to look at, Mark.
That even missed my radar there. I know I get releases. I hear about all the new things that SIBO's talking about, but I have not been watching the bee fly. That's actually an iron butterfly index, which is perfect. That leads us right into our next topic. My own personal favorite. This one's not for everybody. I'm gonna put that out front there. The iron fly. One of my old cohorts on our Volatility Views show years ago made a great comment, and I love it to this day. He said the iron condor is the iron butterfly for cowards. So that should imply to you a little bit of maybe a little bit more risk tolerance needed for the iron fly. So what are we talking about here? It's not like your standard butterfly. Going to be a little bit different. I remember we talked about before just the at the money, buying that one call, selling two, and then buying one of the farther out of the money. This one we're going straight to at the money. That's where the kind of the iron portion comes in. This is useful if you're going long, and in particular, we're going to say a long example. And by the way, you can always reverse all of these and use them to the short side as well. We're kind of looking mostly at the long side because it's a little bit more intuitive for people to wrap their heads around. But this is if you have an underlying, you expect a lot of movement, a lot of bang for your buck, a lot of vol coming in the near future, then this is maybe an approach you want to look at. So you start off with, in this example, we think the stock XYZ at $50 again, it's going to move. It's going to move somewhere. And so we're going to go out and buy that at-the-money straddle, which, as you know from our earlier episodes, is pretty much the most expensive thing you could do. And it's also the most prone to decay. It's going to erode in your face until the thing starts moving. So it's a dangerous road for a lot of different reasons. But for our example, 50 call is going to be $1, 50 put also $1. So we're spending $2 for that at-the-money straddle. So now what? We have the at-the-money straddle. Like I said, this thing has to start moving, and it's got to start moving quickly. Otherwise, the erosion is going to come in and kill us. So people have found ways over the years to mitigate that erosion factor. And one of the ways they have done that is by creating what is now known as the iron butterfly. So you have that 50 straddle you bought. You expect a little bit of movement, but maybe not a ton. Maybe you expect to move it again, like in our other example, let's say to the 55 strike. So in this case, you're going to turn around and sell the 55 call to the upside. Remember, that was trading for 50 cents, so we got 50 cents back there. And we're also going to go to the downside, $5, and sell that 45 put. And for our purposes, let's say that's 50 cents as well. So now we have 50 cents and 50 cents. That's $1. So you collected $1. You paid $2. So now your net outlay is only $1. And what have you done? You've effectively got a vertical call spread to the upside, $5 vertical call spread, and a $5 vertical put spread to the downside. And you effectively paid $1 for both of those. So it's a great way to mitigate a lot of that outlay right at the outset, so you're not crippling yourself with decay if nothing happens and the worst comes to pass. In this case, the worst comes to pass is it just sits there at the 50 strike and doesn't move until expiration. That's where you're really going to feel a lot of the pain. So this iron fly helps to mitigate a lot of that. Of course, reverse that if you want to sell it. You sell the $2, you collect the $1. Obviously, then you want it to sit there. It's a different beast entirely. But that's another use case for it. But obviously, when we're playing with at-the-money straddles, it's a little bit more intimidating. You need a little bit more bang for your buck for these things to really pick off, which is why some people prefer to utilize, and I'll just lump this one in together, and we can kind of break them all down. They prefer to utilize this other strategy, which has a little bit more cushion, I think you could say, a little bit more wiggle room built into it, which Matt and the Director of Risk also referenced, which is the iron condor. This was a very popular strategy, I would say, about 8 to 10 years ago, so we heard a lot about it all the time. Iron condors, iron condors, iron condors. Kind of went away post-2008 meltdown for a while. Didn't hear a lot about it. Starting to make a little bit of a resurgence. This one is our only four-legged strategy we're going to talk about here, hence the commission-intensive nature of it. And this is also useful. Maybe you expect the thing to move a little bit, but you want a little bit of cushion, a little bit of wiggle room around it as well. Again, we're going to go to the long side for our example. Once again, XYZ, $50. And this time we expect it to move and move quite a bit, but maybe we don't want the risk or the decay inherent with an at-the-money straddle. We want to give ourselves a little bit more cushion. We also don't want to spend as much, maybe. So we're going to move that out a little bit. So instead of buying that at-the-money straddle, we're going to instead buy the 55 call, so $5 out of the money there. We're going to spend 50 cents for that. We're going to go $5 out of the money to the downside as well. Buy that 45 put, spend 50 cents for that as well. Now we spend $1. So instead of spending $2, we spent $1. So hence our outlay already less, but you can also see we're not right at the money strike, so we need a little bit of movement for these things to start kicking in. And then, of course, to mitigate our risk, we're going to go farther beyond that now. We're going to another $5 and sell, in this case, let's say the 40 put against that 45 put for 25 cents, so collecting 25 cents back, and sell the 60 call, once again, for 25 cents. So collecting 50 cents, we're paying $1, so net outlay is 50 cents, so it's a lot cheaper from that perspective, which is nice. And also, you don't have that immediacy of the decay that you have around the at-the-money strike. So there are some benefits for it, but also there are some drawbacks. You need a little bit of movement to really start kicking in before these types of trades tend to kick in. So maybe Doctor of Risk, we'll start with you. Again, I should say Director of Risk. You can be Doctor of Risk if you want to. That might be someone else's trademark, though. I don't know. But Mr. Director of Risk, what are your thoughts on the iron fly and, as my cohort used to say, the version for cowards there as well, the iron condor, sir?
Well, the beautiful thing is if you know the regular fly and the regular condor, then you already know the iron condor and the iron fly. So they're synthetics of each other. So I think a lot of people actually start off with the iron butterfly or iron fly because the concept of being able to sell a call spread and then selling a put spread if it's the fly, or selling the out-of-the-money call spread, out-of-the-money put spread in the case of the iron condor seems to be a little bit more intuitive. But, if you're trading a European-style product where there's no early exercise value or early assignment, they're equal. You can call fly, put fly, iron condor, regular Condor. They're all synthetic of each other, so you really can trade anything that you want. You don't want to be that guy going down to the SPX and quoting in the pit, how is the call butterfly, and then turning around and quoting the exact same strikes. How is the put butterfly? Because everyone's going to start laughing at you. Now, if you're doing an American style, fine. There's some early exercise and all that kind of stuff, so there may be some nuances there. But again, iron fly, iron condor, regular fly, regular condor. For me, they're all the same. Again, very versatile. It just kind of depends on, when you're learning about options, or you're trading about options and building a portfolio, it's what makes you comfortable. What are you comfortable with at the end of the day?
Matt, what are you comfortable with, sir? Are you more comfortable, perhaps, with the iron condor than the iron fly? Do you utilize either of these, and do you think they'll see a resurgence of these as well in the wake of the race to zero commission, sir?
So the way I trade, I like to start, like Chris alluded to earlier, with either a call spread or a put spread, and then add on the opposite and adjust accordingly. So that's been one of the better ones in our back testing. And then just from terminology, I always get confused with this, but I term an iron condor as the short, the short vol, and short iron condor is the long vol. And you see it differently online, but how do you guys define that? Like, the regular iron condor is selling vol. Is that true?
Okay, so when I used to teach, we used to teach it, whatever you're doing with the wings, you're long it. So if you were long wings, you were long that strategy. The problem is with what you just said, if you're long wings in an iron condor, you're actually short vol, right? Because you're selling it as a credit. So that was always, when I was trading over at the Merc, you quoted everything in debits, credits. It was very clear. But I know the SIBO was kind of a little different at the time where, and you guys can chime in more because I never traded. I was not a market maker on the SIBO, but I know there was always been this confusion on, are you long the iron fly or short the iron fly? From the Merc, it's whether you bought it or sold it, whether you're long or short. But from a volatility perspective, it would be the opposite.
Yeah, you're right. It is confusing. We used to always quote on the SIBO, it would be whatever was over, right? So if it was a guts or something, that's how you would quote it. Or if it's a skew perspective, that's whatever was over, that was how you would quote it around. Well, so in this case, the guts portion, the closer to the at the money portion, would be the more expensive portion. So that would perhaps lead the dance from that pricing perspective. But I could certainly see, and this kind of gets to the nuance level of options, options and how they're used, and certainly from a terminology perspective. This is kind of, I think, maybe your mileage may vary type thing, even though I tend to look at it from, in that type of iron condor where, let's say, you're buying the guts, the closer portion, and you're selling the wings. I tend to think of that more as, as the longer type fly, because you want that nice movement to kick in, and, whereas the short, you want it to kind of just hover and do nothing. So I tend to quote it that way, but this might be one where perhaps your mileage may vary. And, your mileage will also vary with some of your questions. Let's see if we can squeeze a couple of those in really quickly before we go with a little bit of the old office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. Got a lot of direct, almost personal questions coming in here. Let's see if we can let's got a couple here for each of you. Let's see if we can at least get one in for each of you. Let's start with, I like this handle, Pico de Gallo. So I like that. Just brings a smile to my face. He wants to know, has Matt from Orats ever thought about putting out some sort of tradable earnings vol product? I, for one, would use it. Matt, I'm not sure what he's referring to here. If he's referring to some of your maybe reports and things, you guys do have that already. But maybe he's actually talking about an actual Orats, product that listed on an exchange. So I don't know how you want to view this, sir, but what do you have to say for our friend here, Mr. Pico de Gallo?
Yeah, I saw that tradable earnings vol. I mean, I think what a lot of people ask for is what are the actual strikes that we should do, and winning trades and losing trades, and interestingly, our back tester can scan as well. So if you have and also can back test earning strategies, and we also have triggers in there. So there's a lot that you can do with our back tester, and then scan to see which types of stocks meet all that criteria. So I would say, we have that. And, Pico de Gallo, Matt at orats.com, look me up and see if we have what you're looking for.
I think what he wants, I'm going to go out on a limb and say he wants something like the ORATS basket, where you create the basket and you buy the basket for maybe the cycle or the week or whatever it is, and you guys buy that earnings straddle right before the announcement. You hedge it, right? Sell it right after, or you can flip it. You could sell the basket, and then you guys manage it. There you go, Matt. Is that something you guys want to do? That sounds like a whole bunch of fun.
Yeah. I'm an RIA. I'm sure the SEC would love that if I did that. But it sounds interesting. I've been really liking this earnings season report, and it would be interesting to say, hey, look, here's what it's valued at right now. Do you want to buy that or sell that? I think that would be really cool.
All right, one more, then we got to run. Let's go out to the director of risk. This comes from Malay, maybe? Let's go with Mal. He wants to know, are the SWAN crew planning to expand the DRS to crypto when the options list in Q1? If you've been under a rock, listeners, you heard CME announcing they're going to finally add Bitcoin options sometime in Q1. So, Chris, are we going to see a crypto DRS now that the options are forthcoming, sir?
Well, it's a great question. We are definitely looking at it. I don't know if it'll be rolled out in DRS form from the start. We got to learn the nuances of that product, just like anything else. And I think there'll be some research and development type trading going on for sure. And then hopefully in the future, if that product fits the defined risk strategy, then we'll certainly roll it out.
All right. Unfortunately, listeners, that music means we've come to the end. Man, how an hour flies by when we're talking them. They're out. This show could be like 4 hours. So many questions, so many great topics to get to. Don't worry, we'll be back again soon to talk more advisors and options. But before we go, let me go back around the horn. Let's start with you, Matt, because you're already in the process of creating some sort of tradable vol product. If folks want to pick up that or check out where else you guys have cooking, maybe the earnings reports, maybe they want to hit you up for the RIA side, where should they go? What should they do, sir?
Come on over to orats.com. We have some great new data coming out. Constant volatility at many different delta ranges. Also, we have component-weighted volatilities. That's new for us now. So you can compare, like the XLK component-weighted volatilities, all different volatilities to the actual XLK. So it gives some good triggers, and all those are integrated and baked into our back tester. So we've been very busy, and we got some really cool stuff coming out in the end of Q4 too, Mark. So come on over to orats.com or Matt at Orats. Mark.
There you go, orats.com, ORATS.com. Give them a follow on the old Twitters as well, at OptionRats. It's a catchy one. You can't forget it. And you, too, can check out some of those reports. Of course, if you want to check out the stuff in the interim of theoptioninsider.com, click on that Options News and Articles page, and you can check out all the earnings reports there for yourself. And Mr. Director of Risk, sir, what is cooking outside of the forthcoming crypto DRS, which we'll expect to announce any day? What is cooking in the land of SWAN, sir?
We got a new piece out. It's called Looking Beyond the Mailbox with Systematic Withdrawals. Looks at how withdrawals can shape and impact a portfolio, especially during bear markets. And as always, check out all the great content that we have over at swanglobalinvestments.com.
I was just surfing over there the other day, just checking it out. And you guys have a lot of content over there, including, of course, this show. So if you're listening to this program on the SWAN website, first off, welcome. Secondly, you're in the right place for a lot of content there, research, white papers, blog posts, you name it. A lot of good stuff. So if you're looking for more advisor-oriented content on the option side, in between episodes, SWAN Global Investments, a great place to go. You can also sign up, if you're on the RIA side, you can sign up for one of those 10th box events, maybe coming to a venue near you soon. And of course, last but not least, our friends, Mr. Erik, also out gallivanting again there. Check them out over there. Optionseducation.org is the place to go. Click on that Advisors tab. You can sign up for all their studies and research they do over there as well to arm yourself with a lot of great data. So when you sit down with your clients and explain to them why they should be using these options things, you got some numbers backing you up. Optionseducation.org is the place to go. And on behalf of Matt and the Director of Risk, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in so many questions. We could do a whole other mailbag episode. Maybe we will, because there's so many coming in. We love them. Keep them coming. And we'll see you back here next time for more of the Advisor's Option.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.